What's up guys, this is Chris. Welcome back to my channel. We have a new week of trading here and I've been making some moves in my portfolio. Back in my $155,000 stock market portfolio video, I did talk about 3 things that I wanted to do with my portfolio over the coming weeks and months. One of them in particular was to add more cyclical exposure and to try to find some high quality growth names to add to my portfolio, maybe trade out some other ones. And so here today I'm going to share with you guys 6 stocks that I've added to my portfolio. If you're excited for this, make sure to subscribe and like the video. The first stock we're going to talk about here is Futu, F-U-T-U. This is a company that I've owned stock in the past, and we made some tremendous gains. And it's a digital brokerage, so very similar to Robinhood or TD Ameritrade or Fidelity. Charles Schwab, they have a asset management program as well, and access to pre-IPOs. This company has seen some tremendous growth, almost around 1,000% in the stock price over the past year. And I think there is still a lot of room to grow because of the stellar growth that this company has. You look at some of the financial statements here, their income grew about 10x and their revenues increased about 200+% over the past year. I mean, this is one of the fastest growing fintech companies on the entire planet. And I'd be hard pressed to find a better one when it comes to having that profitability, but also that growth. Now, over the past year, they also added a couple 100,000 paying users. Overall, when you count paying and non-paying on all their platforms, there are over 11 million users, and that is expected to continue to grow throughout the next few years because of this trend where retail investing is becoming such a huge thing. And in Southeast Asia in particular, where they are expanding to, it is a really untapped market where a lot of people are yet to be investors, and those countries are becoming more and more wealthy and more developed, so people have more money to invest with. You know, I don't often buy stocks that I've sold in the past, and from the time that I sold it, they continue to go up a lot, and I pretty much screwed myself. But you know, you have to think about what is the best opportunity for your money, what is the best risk and reward opportunity. And after I've looked over it over and over, I've just decided that I think Futu is still a really, really great opportunity. So looking at Futu here today, went up 16%. Hell of a day. I wish I initiated my position sooner. I was watching this, this bullish flag play out, and it was either going to break down or break up. And, based on fundamentals, I would think it was going to break out. And definitely did so. Some really strong action here, some high volume coming back. They have estimates here, EPS of $5 over the next year. I looked at a couple other sources, have it more of around $3 or $4. So even then, the forward PE is, you could think of it anywhere from 30 to around 50. That is still extremely low for a company that has super high profit margins, 40%, gross margin is 79%. Whatever sales they're getting, a lot of it is coming down to the bottom line as net income. It's just a beautiful thing. If you think about a couple years from now, right? Let's not even think near term, but in a couple of years, this company is going to be doing a few $1 billion in revenue. If this company in a couple years from now does $7, $8 of EPS, which is highly achievable if estimates for this coming year are anywhere from $3, $4, $5. We're talking about, if you place a 30 PE on it or a 40 PE on it because it has so much growth expected for many years to come, this is definitely potentially a $400+ stock. By the way, what's interesting also is that this has a 15% short float. I think that's quite ill-advised to be shorting Futu. I mean, you want to bet against this, but some people do. For the majority, I think they are certainly buying this stock. You look at the institutional ownership has gone up to 48%. And actually, guys, in after hours here, you can see that Futu announced a proposed offering of 9.5 million ADS. Essentially, they are raising more money to fund their operations. You could see here specifically that they're talking about using this money for various things like their margin financing business, which is booming, by the way. People love using margin. International expansion, like I mentioned, United States, Singapore, other parts of Southeast Asia, new license applications, potential investment and acquisition opportunities. Interesting. And other general corporate purposes. Short term, the reaction is to sell off because there is dilution, right? There's more shares that are going to come onto the market. But over the long run, if Futu can sell these shares at maybe 165 or 160 or 150 something, that's over $1 billion that they are generating, and they can use that $1 billion in cash to fund even more growth. And if you're a long-term investor, who doesn't like their company growing more? Second stock on this list is going to be TIGR, okay? Up Fintech Holdings, okay? TIGR is a company that is very similar to Futu. They also are a Chinese online brokerage. I believe there is a slight differentiation between them and Futu in that TIGR also does underwriting for the IPOs itself, you know, the banking process and issuing out those shares as opposed to just enabling people to invest pre-IPO. This is a company that has seen a meteoric rise as well. And that's part and due to over the past year, they also had triple-digit revenue growth. Not as big as Futu's 200 something percent, but you know, 150 is not that bad either. And when you look at the valuation as well, it's quite low. You know, the forward PE here is around a 30 something. That's really great for the amount of growth that you get. A 30 forward PE, I would expect 50% growth tops, 20 something percent growth, 30% growth. I would expect it to, you know, probably be trading at double the valuation it is today. Now you might be asking, why am I buying TIGR and Futu? Well, when you think about it, it's all about diversification. So if something happens to this particular company, but not necessarily the whole sector, then the other stock can continue to rise, right? So it's all about covering your bases, and maybe, I don't know, someday a short seller can go after Futu, maybe TIGR is going to be fine. So, and it could be the other way around too. So that way you don't put your eggs all in one basket. Futu is obviously still the stronger one, so I would suggest putting more money into that particular stock, and that's what I've done. The third stock on this list is Marathon, okay? M-A-R-A. Marathon Digital Holdings is a company that holds Bitcoin, but it also does the mining for Bitcoins, all right? And over the past year, they've done, you know, some pretty babyish revenues, okay? Because they only had a limited amount of mining rigs set up. But over the next year, we're talking about they're adding onto their operations 100,000 of the top tier mining rigs and that they order from Bitmain. So while they may have done a really minuscule amount of Bitcoins over the past year in 2020, and even the first few months here of 2021, they did around 200 Bitcoins. By 2022 first quarter, they're expected to bring on a capacity that's going to be able to mine about 55 to 60 Bitcoins per day. Not per quarter, but per day. So that's already a huge shift from where they are today. And it's happening in a very short amount of time. Bitcoin price stays around 55,000 as of recording here. Then you get around a $3 million revenue target per day. And over a year, if you extrapolate that out, that's at least around $1 billion, $1.1 billion, $1.2 billion in revenue. And the company overall itself is around a $3-4 billion valuation here. So it's essentially trading at about 3 to 4 times revenue in 2022's estimates. So that is a pretty cheap valuation. And when you think about the Bitcoin operation business, when it comes to margins and your expenses, it's quite limited, really. It seems like a really high margin business because besides electricity, which they have a really great contract set up with a couple of electricity providers to have some of the lowest rates in the industry. They're going to have those costs relatively fixed. Of course, you have to buy new machines now and then and add more machines. But overall, the costs are going to be a lot lower than what you're getting out of mining, right? 55,000, 60,000 per Bitcoin, and you're getting 55 to 60 of them a day. That's a lot of money. Now, the thing is, though, it's a big if, right? Does Bitcoin price stay at 55,000 or above by that time? Of course, Bitcoin is super volatile, and just over the past weekend, it dropped like 14%, in just a blink of an eye. But at the same time, Bitcoin could also keep going up to 75,000, 100,000, and then you'd really have to start revising those estimates for 2022. If Bitcoin is 100,000 per coin, then you're talking about almost twice the profitability, twice the revenue, and this stock becomes half as expensive. And it's just a really big value proposition here, but it is, of course, a big risk. I've only put 125 shares into MAR at this point because I do recognize the risk. It's a relatively small part of my portfolio, but if it does continue to go lower, I would definitely consider buying more because I think over the long run, of course, there could still be a lot more runway to Bitcoin. We're talking about 100,000 targets, 400,000 targets, even from, big financial institutions, analysts there. And the way Bitcoin's price cycles go, as you can see on this chart here, I think it definitely could be possible. The fourth stock that I am talking about here is one that I've never talked about on the channel, but it's very interesting here, and that is VALE stock. Okay, VALE is a South American miner, one of the largest world producers when it comes to iron ore, which is then used to make steel. And they also have some exposure to a couple of other elements out there, like nickel, which is used in electric vehicles. So they have some good tailwinds going for it, right? Obviously the electric vehicle boom, but inflation is a big thing because when you have inflation, these companies, their overhead costs and the cost of labor is not nearly increasing as fast as the cost of the materials that they can sell to people, right? You look at the price of steel over the past year, last time I checked, it was up like 100%. So, but if there's more infrastructure spending worldwide, there's talk about that in the United States, then we're talking about some even further increases in these material prices, and the profitability of these companies and the margin is going to increase. This company, by the way, already has a freakishly low PE ratio. It's a 20 PE ratio about when it comes to trailing PE, but you look at the forward PE and it's about a 6. And the third tailwind that we're talking about here is that they're reducing a lot of regulatory pressure. So unfortunately, this company did have some pretty big incidents and catastrophes with a couple of their mining centers. Okay, in one particular location, there was an issue with a dam and the whole thing flooded, and unfortunately, some people lost their lives. But not to put the situation down lightly, they have settled with the government to pay out $7 billion to for reparations, and they are being allowed to increase capacity once again. So their capacity for iron ore is increasing about 30% very shortly over the next I believe couple of months or in a year or two. So that will allow them to increase production and sell more because the demand at this point for these products, I believe, way outpaces supply. In terms of the financials, they have almost $40 billion in revenue and about $5 billion in profits. That's a really good profit margin. We're talking about some big business here. This company has a lot of cash on their balance sheet, by the way, and they just announced not too long ago a 5% share buyback. So they're buying back 5% of the whole company's shares. They're keeping it for themselves. That drives up the price because there is a buyer out there buying, millions of shares out there. And they also have an semi-annual dividend, and the current rate is about 6%. Okay, that's one of the highest rates in the industry, in the stock market, and from a reputable company here. I have 350 shares in at a cost basis around $19.30. The fifth stock that I'm talking about here is going to be YI, okay, YI. Now, I am well aware that this stock has tanked, crashed, destroyed, got smashed, whatever you want to call it. It's been bad. But I generally try to avoid selling or cutting losses unless something fundamental has changed with the company. Based on everything I've read in the company, I've done even more research since the first time I mentioned it on this channel, I don't see anything wrong with it. I think this is still one of the best stocks that is out there in terms of being stupidly undervalued. So we're at a point now where the price of sales is almost 0.5. They did around 100% revenue growth in the past year. This year, they're still aiming for close to 100% revenue growth. This company did $1.2 billion in revenue the past year. This year, they're probably going to do close to $2 billion. And yet the stock price here today is close to $10, and the market cap is around $700 million. Now, whether you consider this a healthcare company or a technology company or just a retail company, any company doing 100% growth back to back to back and doesn't seem like it's slowing down, and they got new partnerships with, they have like 300,000 pharmacies that work with them. I don't really see how this can be so undervalued. So if I lose my money, I lose my money, guys. I'm sorry, but I'm just going to hold. I have 500 shares at this point, and the risk reward seems very, very, very attractive to me. So he, otherwise known as 111, works directly with the pharmaceutical companies who create these drugs, and then they go ahead and act as a distributor to work with offline pharmacies and doctors as well, building those relationships so that they prescribe those drugs and they get the best prices themselves. And what he does is pocket some of the difference in the pricing. Over the past year, they did a net loss, but they're projecting in 2021 to make a slight profit or break even. Moving forward, I think year by year, they're going to be able to increase that profitability and those margins by about 5%, 10%. So longer term, if you're thinking about this company having a few $1 billion in revenue, maybe $3 billion, and they're making 10% income off of that, 300 million in net income, and the stock price is now 700 something million dollars, that doesn't make sense. And by the way, guys, one thing I haven't mentioned that is very important is when you're doing research about the management team, you want to see if they have some strong credentials, right? Some prior experience in the field that they're currently in. So when it comes to Yi stock or 111, I looked up the founders here, and I really like what I see. This guy in particular, Dr. Yu, he got a PhD from Wharton School, blah, blah, blah. More importantly, he served as vice president of worldwide procurement at Dell Inc. and vice president worldwide supply chain at Amazon.com. So that's a wealth of experience in logistics, exactly what is needed, because YI essentially is part e-commerce business, but large part it is a distributor between pharmaceutical companies and offline pharmacies. And his partner here, Mr. Liu, he is also a co-founder, and he has experience. They actually work together at Dell, and they've together also founded a huge e-commerce business, Yihaodian. Yihaodian was actually acquired by Walmart many years ago. And at that time, they were one of the biggest companies out there. Alibaba and JD were around. This was a company that was around too. And it had 57 million users, $0.9 billion in sales. Very impressive. It ranked among the top 5 online retail stores. Apparently, nowadays, this company, Yihaodian, is not doing so well anymore, and Walmart actually exited the business. But hey, at the end of the day, the two founders, they built up this company. They had a lot of business, and somehow Walmart screwed it up. And the last stock we're talking about here is one that I've talked about a lot on the channel, and that is MP Materials. At this point, MP Materials has dropped to around $29.50. I think it's undervalued at this point and a really good entry. Over the past few months, we've seen that MP Materials, whenever it gets to around a 28, 29 price level, it's been a good buy, and I think that this is going to continue. You have a lot of good tailwinds for this stock as well. The EV boom, the demand for NdPr, which is used in magnets that are in the motors of 90% of electric vehicles, past, present, and future, are going to be in high demand, and MP is going to start making their own magnets as well. So that is going to be able to become another revenue source, and the profitability, because they are going to own the whole chain, the whole value chain when it comes to the elements and then refining it, and then they're going to have the magnets themselves. The great thing about this, number 2, is that the United States is really focusing more and more on supply chain as part of national security. And there is a lot of competition with China here. We don't want China to own everything in the supply chain. We don't want to have to depend on them and to trade with them for every single thing. And when it comes to these magnets in electric vehicles, it is going to be so important when it comes to advancement of technology and clean energy and climate change and everything like that. As far as the financials go over the past year, they did 100% revenue growth in the latest quarter earnings report, and they also beat estimates as far as profitability. Very similar to VALE, this is a company that does not have the most expenses, I believe, and most variable costs, right? But the cost that they can sell those materials to these companies that do the extra processing and then make the magnets is going to be big. We've already seen some of these prices month by month. They go up like double digit, like 30% from month to month. The way I see it, this is not just a growth or tech company, but it's being sold off as such. What I also find ridiculous here is that MP just got a reaffirmation from a Morgan Stanley analyst who just 2 months ago or so put a $57 price target on this stock. Now they're talking about a 41 price target just 2 months later, even though nothing happened. Doesn't make sense. Alright guys, so those are the 6 stocks that I am purchasing in the month of April 2021 so far, and they're stocks that I'm really excited for. We have some cyclical stocks and some secular growth stocks. These are stocks that overall I believe will do well in the medium and long term. But let me know in the comments down below which ones you might be interested in or already have a position. I'd love to hear your thoughts as well. Until next time, my friends, stay well and invest responsibly.